Welcome back, ladies and gentlemen. I hope you've had a great week. This story really echoes a common occurrence that's happening all across the nation. And one of my favorite parts of this podcast is the show prep process. It allows me to kind of dig around the corners of the internet, and one of those being Reddit. I came across a column that is really insightful as to the challenges that many are facing. So let's take a look at this together. The title grabbed my attention right away. Our in-laws are over their heads with their mortgage. How can we help? The in-laws are 78 and 70, and they're basically living on their retirement and pension. They have roughly $3,000 a month that's coming in as far as he knows, and the mortgage has crept up as they do, and now they are behind on their homeowners association dues by about $700. Their mortgage payment's about $2,000 a month, and they're only in the fifth year of home ownership, which is interesting, and they're paying $700 a month in credit card payments. So this particular scenario is sad. One, they got into a home just 5 years ago, and they're already over leveraged on their debt. So what happened? Well, the kids came together and decided to contribute about $750 a month, $375 between the two of them. But the kids still have their own financial pressures. They're working 2 jobs each, and they're also pinching pennies. They have daycare and other expenses as well, but now they're supporting their in-laws, his wife's parents. So they're not sure what they can do, and they do not live with them. They're in another state. But here's what's interesting. The father-in-law wants to take out a HELOC, and he's impressionable because he receives many of these offers in direct mail, offering a home equity line of credit. But folks, let's be honest, he's not going to qualify for one. Now, let's assume that they didn't get a home just 5 years ago. If they had the ability to get a reverse mortgage, let's just play along and pretend they did, they would still face some challenges because of their over-leveraged debt-to-income ratio and their history with being late on their homeowners association dues. They would likely be required to set up a lifetime expectancy set-aside or LESA, which would reduce their reverse mortgage benefit. But if it was enough, let's just say hypothetically, to pay off their existing mortgage, then it would eliminate the payment. But here's an underlying truth. Even if the mom and dad, the father-in-law and mother-in-law, could be assisted by the family or even receive a windfall that would bail them out, they would likely find themselves in trouble just a few short years later, because the ability to have that money to pay off the past due credit cards or even part of the mortgage isn't the issue. The underlying problem is their spending habits that they've developed over decades, and those will not go away, even with family assistance or even a reverse mortgage. Ladies and gentlemen, as Social Security inches closer and closer to insolvency, we're seeing more proposals that would fundamentally change how Social Security benefits would be paid to the retiree. And for that, we're going to look at recent reporting from Reverse Mortgage Daily in Housing Wire. According to their reporting, think tanks from across the ideological or political spectrum are floating a common idea, and that is to replace Social Security's wage replacement calculation or structure with a flat benefit instead, with a primary goal of preventing poverty in old age instead of replacing earned income. According to the latest projections, Social Security would be insolvent by 2032, and if that sounds far away, it's not. Here we are in 2026, just 6 short years. In 6 short years, we could see Social Security, the trust fund, unable to pay promised benefits. And if that does happen, benefits would be slashed by an estimated 23% across the board. So, yes, we do need proposals, and we could have used some more responsibility and hard work from Congress in the past, but here we are. For decades, Social Security has operated under the unspoken promise between the American worker and the federal government, saying that the more you earn over your working life, then the higher your benefit will be when you retire. And I would add, that's not an unspoken promise. Any of you that have seen your Social Security statements that show what you're estimated to be paid in retirement once you're eligible for Social Security, to me, folks, that feels like a promise. Now, this model isn't perfect, but it does provide some predictability, especially for homeowners who are grappling with increasing property taxes, insurance, and long-term maintenance costs. Many of the proposals are highlighted by the Brookings Institution, including the Progressive Policy Institute, the American Enterprise Institute, and the Cato Institute. Each of them has a proposal that would fundamentally change Social Security in the future. So this is really the crux of what these think tanks are proposing to avert the insolvency of Social Security. And it is this: rather than have the Social Security benefit tied to your earnings and how much you've paid into the program over decades, instead, it would be a flat benefit amount. And I think that would get a lot of pushback from those who have been paying into the system for decades and perhaps earning a fairly decent income. American Enterprise Institute scholar Andrew Biggs, for example, proposes a benefit that's equal to 28% of the national average wage for single retirees and 41% for couples. So that would be about $19,600 each year, or $28,600 for couples. For many middle-income retirees, this would exceed the federal poverty level, but those higher earners would be losing a larger benefit. For retirees on a fixed income who are facing ever-increasing living expenses and especially property expenses, the next question is, where am I going to look? And naturally, a lot of them will look to their home equity. However, advocates of the flat benefit argue that the goal should be to prevent poverty, not do wage replacement, and Brookings' own analysis notes that the senior poverty level is actually already low when you account for the unreported income. They say the poverty level amongst older Americans is only 6%. But altering the core purpose of the Social Security program, and yes, the promise that was made to Americans, is akin to touching what we call the third rail of politics. It's the quickest way to commit political suicide. No one's going to vote for one who is really looking to reduce benefits. But again, that day of reckoning will come at some point. Rather than doing away with the earned income or contribution model of Social Security for a flat one, there are bipartisan proposals that would restore the long-term viability of the program through modest tax increases, gradual adjustments for higher income earners, and targeted benefit improvements, including stronger protections for survivors to help the homeowners stay financially stable when they do lose their spouse. With the insolvency of Social Security fast approaching, Congress has two choices: fix the problem, address it now, or, once again, kick the can down the road. There is a massive transfer of wealth underway right now in the housing market, and it's going to have long-term consequences. For this, I go to a recent column in Realtor.com. According to their latest story, Sotheby's luxury outlook trend, roughly $6 trillion in inherited wealth, has changed hands just last year, in 2025 alone, as older generations are passing assets on to younger ones. Realtor.com reports that $6 trillion changed hands between the older and the younger generation in 2025 alone, and that is driving many to run to their nearest real estate agent. And with those lucky enough to inherit a significant amount of wealth from their family, they have their pick of investment vehicles, and typically that is real estate. Having watched real estate appreciate significantly over recent decades, the next generation shows a strong appetite for long-term housing investments across diverse markets, says Brad Nilsson, Chief Marketing Officer with Sotheby's International Realty. It's estimated that $124 trillion will transfer intergenerationally through 2048, mainly from the silent generation and baby boomers. It's noted an estimated $124 trillion will transfer between generations through 2048, mainly from the silent generation and baby boomers, and also including some of the Gen Xers. Now, of course, the buying behavior of these individuals who've inherited a tidy sum is going to be quite different than your average home buyer. They're going to be less concerned with interest rates or even prices, in many cases having the ability to buy the home outright. While the overall housing market is stagnant and retracting in many markets across the nation, the luxury real estate market is actually doing quite well. Surprising. According to the firm's latest survey, agents who sell in the 10 million plus range are most optimistic about the year ahead in terms of sales. The fundamentals supporting luxury real estate remain strong, said White. We're seeing sustained wealth creation at the high end. The threshold for a luxury home, reports Realtor.com, across the U.S. is about $1.2 million, but in higher price markets, you're going to see a much higher threshold, such as New York City, Boston, San Francisco, and L.A. According to the latest Realtor.com luxury report, ultra luxury, which is the top 1%, begins at $5.49 million. These properties also tend to be more resilient through economic and housing cycles, benefiting from scarcity, location, and structural supply constraints. Now, surprisingly, some of these markets are not what you expect, such as Heber, Utah. Luxury listings begin at $6.6 million. Key West or Key Largo, Florida, $5 million. LA, $4 million. Stanford, Connecticut, $4 million. San Jose, California, 3.8, and then we have Hawaii at 3.6. For you as a reverse mortgage professional, there are two takeaways. One is that home equity is a storehouse of future wealth, as evidenced in this column when it comes to luxury properties. And as the silent and baby boomer generation do pass on their equity to their heirs, that would increase the purchasing power of these individuals, which would have impacts in specific markets where these higher valued properties are located. Also, for those higher net worth individuals who are in fact considering passing on the home to the next generation, they may want to take a second look, and this is where a seasoned and skilled reverse mortgage professional can speak with them about their options where perhaps they can bake their cake and eat it too. That is, to benefit from utilizing a reverse mortgage, whether it's a HECM or a proprietary loan, and also still passing on a sizable sum of home equity to the next generation.